Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of Exxon Mobil, ticker symbol XOM. This continues our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average. Once we're complete with our analysis, we're going to build three different portfolios: a dividend portfolio, a value portfolio, and a growth portfolio. This is the 11th video in that series, and you can see a link in the description below to all 11 videos. Now, I put the link to the Chevron video first because Chevron's also in the oil and gas industry, and this is a highly competitive industry. And in that video, we went through the industry and analysis, comparison between Shell, Chevron, and Exxon Mobil, and I'm not really going to touch on much of that here. In this video, we're going to focus more on the factors that influence Exxon as a business. So Exxon focuses primarily in the upstream and downstream market. The upstream market is when oil and gas gets extracted from the ground. Downstream is when they refine it and they sell it at gas stations, things like that. And it's important to know that Exxon has always been known as great executors throughout their business, particularly in the upstream segment. Now, there are a few key measurement tools that we can use to see how the energy business as a whole is doing. We can use, the most obvious one is the price of oil or the price of gas. And then you have a rig count, which helps gauge upstream activity. Then you can look at the crack spread, which helps gauge downstream profitability. So for now, why don't we kick it off with a chart of oil? Now, this chart goes back about 5 years, and you may remember that this big dip here, this was back in 2015. But what's interesting to me is that when we shorten up the time frame from 5 years to a bit over a year, well, we can see that the price of oil has been down recently. Now, this is a chart for WTI, which is oil that comes out of West Texas. You may have also seen quotes for Brent oil. Brent oil is a quote for oil prices that come out of the North Sea off the coast of England. Typically, Brent oil is world oil, WTI is American oil, but they act very similarly to each other, as you can see here. Another interesting metric to look at is the rig count. The most popular indicator for rig counts is the Baker Hughes rig count. Here's what that chart looks like. The orange line is oil. The blue bars are rigs. A rig is what they use to extract oil and gas from the ground. The rig count measures all active oil and gas rigs in the United States and Canada. So the theory being, the more rigs that are being added, well, the more confident the industry is in, let's say, the price of oil, the price of gas, the more optimistic they are that if they put this rig up, they're going to make money with it. So that should be a positive for the industry. Although the effects of a rising rig count isn't necessarily black and white. As we can see, rigs have trended higher recently, and more rigs implies a higher confidence. But more rigs leads to more production. More production means that there's going to be a greater supply of oil and gas in the market, which in theory will drive the price lower. Falling prices would lead to less profitable rigs, and that means that in theory the industry is not going to put up as many rigs. So I don't think that the rig count is terribly clear as a predicting tool, at least in the short term. But now where this could be very useful is if we were trying to build a full valuation model. If we knew how many rigs were going up, and then we could get the average price of oil and gas, hypothetically, we could use that information to create a better forecast for revenue and profits. Now, if we were doing that, we'd also want to know how Exxon was doing in their downstream business. And for that, we could use something like their refinery throughput. Throughput is a measure of how much crude oil ExxonMobil can refine. Basically, what's their capacity? Now, to tie this all together, this chart is very helpful. This chart is capacity utilization. So this tells us, if you look at the tall middle bar, we can see that a bit over 93% of their available capacity was used. The higher the number, the better for capacity utilization. Okay, so now how do we value Exxon? And should we add it to any of their portfolios? First off, their dividends are pretty good and rather reliable. Their current dividend yield is about 4%, so that's good to know. But we also know that the price of oil has fallen recently, so let's see what analysts think about revenues and profits going forward. Okay, so here's a chart of revenue. The green bars are estimates, and it looks like analysts are expecting a dip in revenue going out to 2020 and 2021. When we look at earnings per share, we can see the same thing. Now, a lot of these projections will have to do with the price of oil. When oil went down back in 2015, we can see that had a lasting impression on earnings per share. Now, if you saw our Chevron video, you may remember that one of the things that we uncovered was that the downstream segment for oil and gas companies tends to be a large driver of revenue, but not an enormous driver of margins. Now, one of the things we can do to gauge how margins are being driven is by looking at something called the crack spread. Basically, in refining, the process of refining includes cracking oil, crude oil, and breaking it down into things like gasoline, heating oil, diesel, jet fuel, and things like that. Well, this chart, this is the Cushing 3-2-1 crack spread. The crack spread can be used to project refining margins. And there are a whole bunch of different crack spreads that could be used. But in this example, the 3-2-1 crack spread, it assumes that for every 3 barrels of crude oil brought into the refinery, 2 barrels of gasoline are produced and 1 barrel of distillate is produced. To sum it up, basically what it means, the higher the crack spread, the higher profit margins should be. Okay, so now we know oil has been on a steady decline recently. The crack spread has pulled back a little bit, but overall it still appears to be in the same general area it has been over the past few years. So the real question is, how can we try to come up with a fair value for ExxonMobil? So once again, as I said in the Chevron video, I'm a big fan of enterprise value to EBITDA for these types of companies. PE tends to be a bit too volatile, and when we look at the volatility of energy prices, that makes PE very difficult to use. Where EV to EBITDA, on the other hand, is a bit more stable, and I think it's great for oil and gas companies, and it's very popular among analysts, so I think that confirms at least the stability of it. So now the first question is, what's Exxon's current EV to EBITDA multiple? So currently, Exxon is trading at a forward EV to EBITDA of about 6x. So where should it be? Well, when we look at Exxon's 3-year average, it's about 9x. Their 5-year average is about 8x. So according to their own history, it looks like Exxon may be undervalued. How about their competitors? Well, Chevron is currently trading at a forward EV to EBITDA of about 5x, while Royal Dutch Shell is trading at about 6x. So according to their peers, it would seem that Exxon might be slightly overvalued. But you may remember in the Chevron video that Exxon's business is a bit more stable than both Chevron and Shell. This was the chart that I showed in that video, and this orange line, this is Exxon's profit margins. And as you could see, despite the collapse in oil back in 2015, Exxon remained positive. Meanwhile, Shell lost money, and so did Chevron. So with this in mind, it makes sense to me that Exxon would be trading at a premium relative to peers. So now the question is, which multiple is the best multiple to use? So when we think back to the price of oil, we know that it's fallen recently. So is the crack spread. Now, if we go back to this 5-year chart of oil, we can see that this chart, this 5-year chart, includes oil above $100 a barrel, a collapse, a recovery, and the current pullback that we're in. So to me, using a 5-year average for our EV to EBITDA multiple would incorporate all of this craziness in there. So to me, that is a reasonable multiple to use. Another reason I like it is lower than the 3-year average, which implies a more conservative approach, which I'm okay with. So if Exxon was trading at its own 5-year average of 8x, now that 8x was actually 7.75x, I just rounded it, but to be more accurate, I'm going to use the 7.75x for our calculation. Now, EBITDA over the next 12 months is expected to be about $59 billion, giving us an enterprise value of a bit over $464 billion. Now, all we need to do is subtract debt. Net debt was about $39 billion, dropping the fair value of our equity to about $425 billion. Divide that by the shares outstanding, and we get a fair value of about $100 per share. Now, given that the current stock price is about $80 per share, it seems that Exxon could be a good buy in this area for a long-term portfolio. Now, if we add this to one of our portfolios, we have to be ready for oil to keep collapsing. And we know that over the short term, it might look like Exxon's a good buy right here, but we also know that energy companies aren't in control, generally, of the price of oil. So if it keeps falling, we have to be ready for them to keep falling with it. Now, we already mentioned that Exxon has a pretty good dividend at about a 4% dividend yield. So it makes sense for this to land in our dividend portfolio. I think that could happen. Since it's undervalued right now, it might also make sense in the value portfolio. I'm not sure about the growth portfolio because I think that the profitability, the revenue growth, a lot of that is driven by the commodity prices, and they're not really in control of that, and that scares me from a growth perspective. Now, the question is, what do you think? Which portfolios do you think ExxonMobil should land in? And if you haven't done so already, hit the subscribe button. I appreciate you sticking with us all the way to the end of the video, and I look forward to seeing you in the next video. Thanks.